Welcome back to Be Great Economics. This is Nate, your class leader. So today's Sunday and I got some things done around the house, and then I realized I need to talk about the bond market because as any sane person would do, I spend my Sunday and day off researching bonds. So the first thing I'm going to show you is the 10-year bond yield. And with the 10-year bond yield, what I've done on this chart is I've inverted the bond yield. The reason why is so that it helps you visualize that the bond price is going up when the bond yield is going down. And so the bond yield is what you're getting every year for holding the bond. And the bond price going up would be bad because you want to purchase a bond at a lower price and you want to sell a bond at a higher price if you're going to sell a bond. Ideally, you purchase a bond and hold it for the yield. Now, I'm going to talk about this as a bubble. Why is this a bubble? Well, we have the bond yield hit 0.33% return. So if you had purchased a 10-year bond in March of 2020, you would have gotten a 0.33% return year over year. That is incredibly low. Why would you have purchased a 10-year bond yield? Because the market crashed and the expectation was that overall market yields were going to be bad. Once money was injected into the system, a bunch of extra liquidity was added, a little bit of the fears began to belay as asset prices began to rise. So the bubble had to alleviate some of the pressure because it was very clear that we were not going to get even higher bond price than only yielding 0.33%. So right now it's at 1.5% or 1.48%. And if you're holding a bond right now, especially if you purchased one in December of 2020, let's say the price came down a little bit and you said, okay, the bond yield's starting to get better, but I'm a little cautious about this market. Let's say you bought a bond in December 2020. Well, the bond price continued to fall, which means that you lost 0.74% of the bond price or 0.74% of the yield. And that bond price drop causes you a loss. Now, on top of that, from December 2020 to December 2021, we now have 6.8% year over year inflation. So you've also lost that. So accounting for that, you have a 6.8% inflation. You're at a 7.45% need to make gains. So you're at that loss. And if in the first year you're at a loss, that might be fine if you have a 10-year view. However, do you anticipate for the next 10 years that inflation will be below an average of 2%? I don't think that that's the case, and I don't think that the market thinks that either. I think that this is a bubble, and when I talk about it being a bubble, it's a fear bubble. Why am I going to say that? Well, when people buy bonds, they're expecting that the market is going to, if they're purchasing bonds and the rate is below inflation, they're anticipating that either the inflation is going to fall, so we'll have disinflation, or they're anticipating that the price of the bond will go up. And why would the price of the bond go up? Because people pile into it and get out of other assets. So they're expecting a crash. So if you're purchasing bonds right now, you're anticipating a crash, supposedly, or a growth in the price of the bond. That's still a losing bet right now, but maybe in a 10-year span, you have a longer term view that you're going to see a form of depression. But most of the evidence on inflation is going to show us that we're probably not going to see it average below 2%. And I would argue that if you purchased a bond, a 10-year bond in the past 3 years, you have about 1 year left for us to start averaging below 2% inflation, or you are absolutely at a loss on the average of the past 3 years bond yield. So you've lost money for 10 years, or at least purchasing power. That is not a good trade. I don't think anyone would really, saying there's stability and taking a loss, the only thing that it's better than is holding the dollar itself. So if the reason that you're in bonds is simply because you want to be better than the dollar, but you don't want to be in any other asset, you're making a losing trade. So most likely, this is an attempt to go long on the bond price and then flip short once this event occurs. So why would you be in bonds when they're negative? Well, history shows us there's a couple of times in history where we go negative. And they're usually during wartime. So we have a history of World War I, World War II, where bond yields were negative. There was yield curve control in place. However, the real return on those bonds were negative because people also were actually fearful. They were seeing that there wasn't growth in the economy and there was mostly an inflation due to war fighting. And so they were preparing for anything to get worse or the world to turn even more chaotic. Now in 1970, the purchasing of bonds was probably a bubble because they expected a recession. And in 1975, they got it. However, you can see that this bubble continued a little further than 1975 as the recovery began. And so the bond market had to rapidly deflate. And so that bubble had to crash. And it moved into other assets. And then stocks were not going up at the time. In 1975, there was a recession. There was an uptrend. And then in 1978, it began a downtrend again. We had a kangaroo market over a 10-year period of up, down, sideways. But gold was going up. And so people were trying to offload from stocks and bonds into monetary assets that are limited resource. Why? Because there's no limit to how much capital you can flow into a monetary asset, because it's simply a supply and demand function. It doesn't produce anything and it has no yield, but the yield you get is from growth. So effectively, it's just everyone piling in on saying, I would rather have this than anything else around me right now. And so when we look at market cycles, there are two phases of fear that I want to highlight here. And these two phases are the hard part to discern. So you have a moment of fear when the market begins to downturn. And the concern is that this moment of fear is going to lead to a crash. The next moment of fear is at the bottom of the crash. And so the problem is trying to discern, are we here awaiting a crash, or are we here at an upturn event? Sorry, my cat is playing with a toy. And so here we have the NASDAQ, and I'm going to show you the same kind of events playing out. We had a massive overbought period. You can see on the RSI, it broke out of the standard band. That's the relative strength index of the move. And then over here, you have the moving average convergence divergence. And so it showed that we were immensely overbought, and then we went into kind of sold territory, not necessarily oversold. And so the market is trying to figure out, as you saw in the previous weeks, we had extreme fear last week. We had extreme greed the week before. So if we had extreme greed in the peak, we had extreme fear in the trough, and then we have kind of fearful here. Are we in complacency, or are we in disbelief? That is, again, the hard part to tell, but combining this information about the bond market and the NASDAQ, the risk on trade, the counter trade to bonds, kind of starts to show you that they're both in a bubble and they both have to disinflate. Now, that doesn't necessarily mean that the NASDAQ has to crash. Because of inflation and the fact that the money has to flow out of the largest security asset in the world, the US bond market, it'll flow out and move into other assets. And that would mean stocks would get it. However, stocks are extremely overvalued. We have forward PEs, price earnings. The expected return will essentially be not very good to begin with. Then when you account for inflation and companies' costs of operation going up faster than the sale price of their assets, they're absorbing some of that inflation, but it's going to come back and bite them. And so they're going to start taking losses in real terms. Whether or not it's nominal is another issue. And so the faster the market realizes that this is starting to occur, the more they're going to seek out monetary assets. And so again, I show you this chart on what happens in a monetary controlled asset inflationary market where money supply is injected to protect asset prices. In a normal corrective activity, we see that the monetary asset goes down with the bond, and we would go through a dip, we would find a bottom, max fear, and then eventually we would work our way up. Because we can't sit in a depression forever unless we're going to add economic uncertainty due to either externalities or government activity. And so if we anticipate more chaos, we will extend this trough timeline, but eventually a bottom will be found in fear, and then there's nothing but upside once the future valuation actually comes to fruition. The problem here is that we injected liquidity into the crash, and we've gone through part of this cycle, and I would say that we're in this stage here where we're seeing a deflation that's preceding the stock deflation in the monetary assets, and the bond price is starting to come down, but then it's also getting bid up again. And so this swing may be your opportunity to move into monetary assets rather than being into stocks or bonds, because this kind of has to play out no matter how you look at it, whether it's real valuation or asset inflation, real valuation, it doesn't really matter, because the bond yield still has to outflow to somewhere, and it's not just gonna bid up securities. So it's going to have to bid up commodities as well and monetary assets to absorb that inflation risk. Now, the other thing I want to talk about is how there's a predictive nature to the bond market. Now, I am not saying here that every bond investor is a smart money investor, because we're talking about potentially being in a losing trade here. But when you read the yield curve, the difference between short-term yields like 1-year yields or 3-month yields to 10-year and 20-year yields, you start to identify a curve that can be established. And when the curve inverts or moves down, that is predicting a recession. Now, in a study in 1986, a man proved that, what was his name? It was Campbell Harvey, proved that the bond yield curve inversion has a 90% accuracy of setting up to read a recession. Well, in 2019, late 2018, early 2019, this news hit the market that, hey, the bond yield curve inverted. And it became a rather panic moment because people were wondering, when does this recession start? In 2020, we did have a form of recession. We had a crash and we had low productivity. But was the bond market predicting a natural event of a virus being released? Or was the bond market still responding to the stimulus of the planned monetary control? Because I don't think that the bond market could see that event. It's probably more likely that the bond market foresaw yield rate hikes, and that the yield could not, not yield rate, interest rate hikes, and that the interest rate could not remain at zero, because in 2018 we had a taper tantrum where the markets began to crash as quantitative easing was starting to be relieved. And so what we're seeing is probably the prediction of not 2020 or even 2021, but probably 2022, 2023. Now, being early is a pretty big sin in the investing world, but being early also is the best way to maximize your absolute gains, other than catching the momentum right before it takes off in a parabolic phase. Those are the 2 points you make the most money, is catching the initial start, going through the long-term growth and getting it all the way to the top, or catching the parabolic trend and maximizing leverage. Which one's riskier? Purchasing monetary assets now would be a safer bet than purchasing anything else at this time due to the bubble valuations. And the only thing that's gone down in value is monetary assets when you compare them across the spectrum. Now, that's not to say that stocks have to crash, but again, the valuations are already very high and the inflation is also high, which means that their valuations are going to begin to decline in real terms. And here is the yield curve's prediction right now. As of December 2020, it is predicting a 100% chance of at least one interest rate hike. If an interest rate hikes, then leverage becomes more expensive and prices begin to disinflate. Now, the problem here is that the Federal Reserve gets a vote. The bond market is predicting at potentially 3 rate hikes, 50% chance of up to 3. And if there's 0.25% rate hikes, then your interest rates in your bonds will drop even more, and the markets will begin to disinflate. The other problem is, what about if the Federal Reserve tapers its asset purchases but doesn't increase rates? Now the bond market has made a losing bet, because now they have to have the yield on those bonds drop, because the asset purchasing going on by the quantitative easing is going away. And so there is one massive buyer, which is approximately 40% by the Federal Reserve today. One massive buyer has just slowed down or stopped completely its bond purchases. They're probably not going to stop completely, but they're currently projecting to taper their activity. If they do that, then the outflows have to happen. And if the outflow in the bonds have to happen, and again, stocks are very highly valued and monetary assets are low valued, you're going to get that Cantillon effect where there's more opportunity in total growth in the monetary assets than in the stock market. So right now is a better smart money buy into monetary assets. And so just for a final note, if you don't think they won't raise rates, this is why the bond market predicts that they'll raise rates, because they have a history of doing it. When you have a bubble occur and leverage and lending get too high, instead of having a naturally occurring rate, we have a fixed rate by a central entity. And the fixed rate tends to rise when they're trying to disinflate over valuation, over exuberance, and over leverage. What does that cause? It usually causes a market crash. So the bond market is expecting that in this general decline of capability to raise rates, that they will still attempt to raise rates in order to disinflate asset prices. If they taper and then it's followed by, again, if they taper and then it's followed by interest rate hikes in order to, again, disinflate the market, you're still going to get the same effect. If they taper and don't interest rate hike, the bond market has made a mistake and it still has to outflow. So no matter how you look at it, the game theory plays out that asset prices have to increase due to bond market outflows, but that opportunity increases via the Cantillon effect to monetary assets. I think that this makes the most sense at this time. And so my thoughts on why you would be purchasing monetary assets and monetary asset revenue companies would, like mining companies, would be an immense opportunity here, especially if it's a low valued monetary asset like silver or Bitcoin, where they have a $1 trillion market cap. I realize 1 trillion sounds big, but when you do comparative valuations to the S&P 500 and to housing, you realize, oh, this actually is a very small market. So thanks for watching. I hope to see you again, and I hope you took away anything from this. And if you have comments, leave them below and let me know what you think of the bond market and whether or not that bubble has a rationale to it, or if there's an exuberance or excessive fear in the market and it needs to correct. Thanks for watching.